Which stocks are being boosted by the Iran war so far? This video explains the market winners, the reasons behind the moves, and what to watch next. Published March 3, 2026, markets reacted quickly. We summarize the top-performing names and the sector drivers in plain language for investors and curious viewers. We focus on three main winners: defense contractors, energy producers, and service companies, and gold and miners acting as safe havens during geopolitical risk. This explainer uses clear tickers and simple chart animations so you can see percent moves, volume changes, and the reasons traders moved into these names. A quick note: we cover market impact and early winners only. This is educational, not investment advice. Always check fundamentals and your time horizon before acting. Now let's dive into the first group: defense companies that saw immediate inflows as geopolitical risk rose and expected procurement increased. Lockheed Martin, ticker LMT, was a clear market winner as traders priced stronger demand for jets, missiles, and long-term defense contracts. Northrop Grumman, ticker NO, outperformed on expectations for drones, surveillance systems, and electronics that are in higher demand during regional conflicts. Raytheon Technologies, RTX, saw gains tied to missiles, radar, and avionics orders. Markets often react fast to expected government procurement cycles. Elbit Systems, ticker ESLT, an Israeli defense firm, recorded spikes as regional demand for surveillance and electronic warfare capabilities rose sharply. Investors used aerospace and defense ETFs like ITA to capture sector exposure quickly, widening demand beyond single-name buying into broader funds. In short, defense stocks rose because markets expect higher procurement and urgent upgrades, translating geopolitical risk into predictable revenue streams for suppliers. Energy stocks reacted to potential supply disruptions. ExxonMobil, ticker XOM, moved higher as traders priced tighter crude availability and shipping risks. Chevron, ticker CVX, saw similar gains. Markets often pre-price any regional instability that could affect crude shipments or routes through the area. Energy services firms like Schlumberger, ticker SLB, can benefit later if higher prices prompt more drilling and infrastructure spending worldwide. Traders also flowed into oil ETFs such as USO to hedge or gain direct exposure to rising crude prices ahead of supply shocks. Gold and major miners outperformed as safe havens. Newmont, ticker NEM, and Barrick, ticker Gold, attracted flows as investors bought protection. Commodity prices, shipping insurance costs, and regional sanctions can all amplify energy and miner returns, but these drivers are often volatile and news-dependent. How do these moves happen so quickly? Large traders and ETFs shift capital when they price in risk, creating momentum across correlated stocks and sectors. Options markets and futures amplify reactions. Rising implied volatility and options activity often precede or reinforce large directional moves in equities. Volume spikes and widening bid-ask spreads signal real repricing. Watch for sustained volume to confirm a durable shift rather than a headline-driven blip. Simple chart animations can show percent change, relative strength versus the S&P, and volume to help viewers judge whether a move is broad or isolated. Common ETFs to monitor include XLE for energy, GLD for gold, ITF for aerospace and defense, USO for oil futures exposure, and sector-specific funds. Remember that headline-driven flows can be fast but short-lived. Confirm moves with volume follow-through and fundamental updates from companies and governments. Short-term spikes can reverse quickly. De-escalation, diplomatic deals, or alternate shipping routes often cause rapid mean reversion in affected stocks. Sanctions and export controls add second-order effects. Companies with complex supply chains or regional exposure may see earnings impacted beyond initial price moves. Earnings reports and government budget announcements will determine which defense contracts and energy investments actually convert into revenue growth. Practical monitoring tips: set price and volume alerts on tickers LMT, NO, RTX, XOM, CVX, SLB, NEM, Gold, and ESLT, and follow procurement news closely. Quick summary: defense, energy, and gold have been the main winners so far. ETFs offer broad exposure, and stocks offer concentrated, higher-risk bets. Final takeaway: treat geopolitical-driven moves as volatile. Define your horizon, monitor catalysts, and rely on data rather than headlines when making decisions.